Hello everybody, I'm Steve Cassaday, Chairman and CEO of Cassaday Company, and I wanted to speak directly to you today about the market and economic activity that we've seen for the week ending March 20th, 2020. We can appreciate how stressful this has been for everybody, and we also appreciate how steadfast our clients have been in remaining fully invested and broadly diversified as we have advised. Based on input from our Client Advisory Board, we've come up with a number of topics that we'd like to expand on that will help you understand our thinking about the markets and what we see looking forward. The current crisis is similar to 2008 in that there are many unknowns, yet it is different in that it is not a financial crisis, it is a healthcare crisis. As we have said repeatedly, programs are driving volatility and are largely responsible for the large swings on the upside and the downside that we're seeing every day. Programs essentially are algorithms that automatically sell and buy once markets go up or down by a specified amount. Unfortunately, they don't have any compunction about selling, they're totally indiscriminate about what they sell, and they tend to exacerbate whatever trend is in place at the time. Algorithms have been further driven by the fact that hedge funds, which are significantly over-leveraged, have been forced to sell their assets in order to pay the debt that they have on those portfolios. This is a big problem and also occurred in 2008. The good news about hedge fund deleveraging is that it will end. In fact, we believe most of that selling has already taken place. Now, everything is down, but over time, diversification has worked, and we believe it will work looking forward. It's important to realize this crisis will cause high unemployment and will stress the economy. We expect second quarter GDP to be down double digits, perhaps as much as 15 to 20%, which is unprecedented. We think, however, that the decline will be fast and steep, but we believe short. Some investors are panicking, and this is also adding to the decline. The toilet tissue hoarding that we're seeing in supermarkets and this panic are the same thing psychologically. It's important to remember that. Panic is not a strategy. Now, corrections are good. They wipe out the leverage that we discussed earlier, and it discourages those who are not long-term investors. Markets are down 30%. Our accounts are not down as much, but nonetheless, this is the time to put risk on, not to take it off. Although the risk of more downside exists, we see this as an opportunity, perhaps an opportunity that won't be seen again for a generation or more. The fiscal policy and stimulus that we're seeing now is actually a short-term solution to keep the economy from collapsing. The stimulus could be $2 trillion, but it needs to happen. Beating the virus is an intermediate term and perhaps more important solution. It's probably a 60 to a 90-day issue for the US, but it could be longer. China quickly is recovering, and many factories are running at 80% in 10 weeks, but we don't know if the data is accurate. South Korea and Singapore have also flattened the curves. We're hopeful that the US will look like that at some point. The big question on everybody's mind is this the bottom? To be perfectly honest, there's no way to accurately call a bottom, but we believe these things. The markets are very oversold. Forced selling that I mentioned earlier will not last forever, and we think it's probably mostly done. We are therefore probably closer to the bottom than we are to the top. Stocks are now reflecting a very, very bad situation, which we probably don't think will materialize. The real problem here is the investing public needs visibility to a decrease in the number of coronavirus cases and or some kind of treatment that slows the progress and shortens the cycle of the virus. And we're starting to hear things like that might be happening. So the traditional pattern of a stock market bottoming includes tremendous volatility, which we have seen, bottoming, which means we start to see the market bouncing off of certain levels, which we have also seen, retests of those levels, in other words, additional declines, some of which will be scary, that hopefully will hold at the previous levels. A trading range begins to form where the market moves up and down between certain ranges, and then a base building, which means that trading range goes on for a couple of months and builds a base. There's an old Wall Street saying, the bigger the base, the better the case. And so we think we'll see at least a month or two of base building and then a resumption of uptrend, especially if we have some kind of developments in terms of the impact of the fiscal stimulus as well as some kind of progress on the coronavirus. With regard to our assertion that markets are already reflecting a very bad case, look at this chart which shows the decline in all 8 S&P industry sectors since the market high on February 19th. As you can see, it's been a bloodbath. These prices are reflecting a broad, deep, and long recession, which we do not expect. The odds are dramatically against that. We could be wrong, but we feel pretty comfortable saying that. The graphic that you see on your screen now shows 38 years of S&P 500 returns. The blue bars are the ups and downs for each of the 38 years, and as you can see, only 7 of the 38 years actually had negative returns, which supports our thesis that remaining invested is the best choice, despite occasional drawdowns that are pretty scary. The gold dots are what I want to call your attention to. These are the maximum drawdowns in each of the 38 years. What is clearly observable here is that despite each year having negative returns at some point, almost all of the years ended up. This is important because despite intra-year declines, markets can actually still be positive. Not necessarily saying that we should expect that this year, but it has happened a number of times before from the levels that we are now at. So we believe you should be optimistic that at some point your portfolios will recover. Let's take a look at recoveries historically and see what they have done. I think 2008 is probably the best example. The graph that you see in front of you here shows our model's performance from the peak of the market in 2007 to the bottom in March of 2009. As you can see, each one of these lines have very different characteristics. The S&P 500 is the dark green line, which has the greatest decline, as you would expect, and then each of our models have decreasing declines as a result of their increasingly conservative nature. The gray line shown by the red arrow is our moderate growth with income allocation, which is our most popular model. In fact, if you blend all of our other models, they look a lot like moderate growth with income. So we believe it's representative of what you should expect as an investor at Cassaday Company. As you can see, the decline of moderate growth with income is significantly less than the overall decline of the broad stock market. Generally, this is the way we expect these diversified portfolios to behave, and that in fact is what has happened in this decline in 2020. Although you have suffered declines, our role is to diversify the portfolio so that not everything goes down and your assets are protected to some extent. So now that we've seen the decline in 2008, let's look at the recovery in 2009 and see what we can divine from the performance of our models during that time. As you can see, moderate growth with income, which again is the gray line, has had a significant recovery, but has not recovered as much as the broad market or as the more aggressive moderate growth and growth models have, which is to be expected. Things that go down more tend to go up more when markets recover. What you see in this slide is the complete cycle, which combines the previous two slides into one, from the peak of the market in October of 2007 till the decline that we saw in 2011. A couple of important points. I want you to notice the two red arrows. The first arrow that appears shows when moderate growth with income broke even. Peak to trough, back to even was a little over 3 years. On the other hand, if you look at the more aggressive models, especially the S&P 500, it was nearly 5 years for the S&P 500 to recover, almost 18 months more. This is significant, especially if you're taking withdrawals. If your portfolio is too aggressive and you're taking withdrawals and it has a persistent decline and takes nearly 5 years to recover, that's dangerous, which is again why we recommend broad-based portfolios. Here's another slide that's dedicated to the study of recoveries and how they behave. This shows every decline of 30% magnitude in the S&P 500 since 1965. As you can see, they all bounced and they all recovered, as we believe this decline will become a recovery. Look where we are relative to the historical declines and what happened after we reached the point we are now at with the S&P 500 to these markets in the previous instances. As you can see, the recoveries were quite robust. Again, why we strongly urge that you remain invested. If you miss the recovery, it is really bad for your overall returns. The next slide shows all of the declines historically since the Great Depression that are greater than 30%, similar to where we are right now. What's interesting is the returns in the 1 year, 3 year, and 5 year periods, which average about 138% over 5 years. Selling now means that you will miss those potential returns looking forward. Again, why we emphasize remaining broadly diversified and fully invested. One of the most common questions we're getting from clients during this market decline is, should I stop or should I reduce my portfolio withdrawals? The answer is no. If there's a problem there, we will let you know proactively. Here's why it's not a problem yet. As you can see in the graph on your screens right now, this shows a hypothetical $1 million portfolio taking a $50,000 or 5% annual withdrawal. The withdrawal as a percentage of the portfolio gets larger as the portfolio declines. And when it's down 35%, your 5% withdrawal becomes an almost 8% withdrawal. 8% withdrawals for most of our clients are probably not sustainable, but you can do it for a year or even 2 years without significantly damaging the portfolio, at least based on history. We watch this proactively, it's automated, and we will let you know if you need to stop or reduce your withdrawals. At this point, for most of you, that's not going to be a problem. The final graph shows from our diesel study what our model portfolios, hypothetical versions of our model portfolios, have done since 1973. In these examples, we hypothetically invested $1 million in each of the portfolios you see on the screen and then took a 7% withdrawal and increased the withdrawal by 3%. As you can see, our more popular models like moderate growth and moderate growth with income, despite being obviously quite volatile, survived and actually were able to sustain these large withdrawals. Now, there's no guarantee that this will work looking forward, which is why we are proactively watching your portfolio's withdrawals for the phenomena that we showed you in the previous slide, where your withdrawals as a percentage of your total portfolio value get too large. If that happens and the decline is persistent, we will let you know, and we may advise you to take a smaller withdrawal for a period of time. Doing this more fully assures that your portfolio won't run out of money. Finally, I want to talk about helping the community. As all of you know, charities are hurting badly as donations have come to a screeching halt. We are being generous and will likely exhaust our charitable fund over the next few months to make sure that these charities continue to do their very important work. Also, something that's really not on the radar is blood shortages. The Red Cross is very, very short of blood. So it's safe to give blood. You'll have to be tested for the virus before you give blood, but we will be sending out a connection for you to be able to look up where you can go to donate blood. This is very, very important. Also, if you have ideas about how we can help businesses, healthcare workers, or any others in the community who are in need while still remaining safe, please share them with us so we can act personally to help these very deserving groups. As always, if you want to discuss your portfolio or financial plan, please don't hesitate to contact us. It's easy to set up a remote connection so we can do a video conference, and of course a phone call is always fine as well. We are always available to answer your questions or address your concerns. In closing, thank you very much for taking time to watch this video. We hope you found it interesting and informative, and please stay safe during this very scary time.